So crypto has been on a slight little bull run in the last week, and yield farm that I have been participating in has been significantly given me increased yields as well. So in today's video, I'll share places that I'm putting my crypto at, where they are earning, and how you can get on board as well. So right now, I'm mainly using two different platforms. One is a CX or a centralized exchange, and the other is a DeFi protocol. So looking over the centralized exchange, we are using Gemini right now, and there have been some controversial things about Gemini and their earn program, but in Gemini, I'm only using the Ethereum staking service, which I feel is pretty decent. So in Gemini, I got just under 1 Ethereum, which is staking at 3.96%, and this number floats depending on when you watch the video, and the rewards are paid out in Ethereum, which sort of gives you a compounding effect. But if we do a side-by-side comparison with Ethereum org, where we can see the APY is slightly lower instead of the higher APY that Ethereum side is showing. So for me, I don't really mind earning lesser in yields because it allows me to easily stake Ethereum without running hardware 24/7, which can end up me having my reward slash if I'm not keeping the network up.
Original reward.
And at the same time, Gemini is one of the places that I off-ramp my crypto, which makes things really even easier for me if I wish to take out some profits to have them reinvested elsewhere. So if you go into my details, you can see that the last 30 days, I roughly get about $2 in Ethereum. It's not a lot, but since Ethereum is a volatile asset, this value can change and will change when there's a price movement in the market. And in recent times, there has been talks about validators requiring 2048 Ethereum instead of 32 ETH moving forward, so the barrier of entry is really getting higher. But this is something good for the long run, but it can also result in people dumping Ethereum because it just doesn't sound attractive anymore.
You're attractive, Catwoman, but not that attractive.
So if you do have Ethereum lying around and you're looking for a place to grow them on the CX, Gemini will be something for you to consider. But if you are the kind that I don't trust CX, I only want DeFi, so do consider Lido Finance or Lido.fi, which allows you to do liquid staking. So in liquid staking, you get a receipt token, and in this case, it will be STETH or Stake Ether. So previously, I did some staking with Lido before, but when the Ethereum Shanghai upgrade came, it allowed withdrawals, and I moved my Ethereum into a centralized exchange because I wanted a way to off-ramp quickly if I needed liquidity in something else. So now let's move into the DeFi space. So in the DeFi space, I'm on the Arbitrum network providing liquidity for the exchange GMX. So GMX is a decentralized spot and perpetual exchange that allowed users that, like me and you, to trade Bitcoin and Ethereum directly from your Web3 wallet. So having said that, to embark on the DeFi space, you'll need to have a DeFi wallet or Web3 wallet, which we might cover in a future video. So on GMX, there are two main tokens that support the exchange. We have GMX, which is the utility and the governance token, and we have GLP, which is the liquidity provider token. The GMX protocol has a few tabs here. We won't be going through all of them because this will take a 30-minute video to do so, which we don't want. So the important tabs that you want to look at here is the earn and the buy tab. Under the earn tab, this is where the magic happens. Here you can see different numbers and different stats. So on GMX, I'm providing liquidity through the purchase of the GLP token, and each GLP token is roughly $1 right now, and it provides an APY of roughly 10 to 12% if I'm not wrong. And the APY changes because it's dependent on the fees that are collected. So if there are more fees collected, you get higher APYs. So if you're providing liquidity through GLP, you'll get a share of 70% of the platform's trading fee. And if you're using Arbitrum like me, the rewards will be distributed in Ethereum. And if you're using the Avalanche network, you will get your rewards in AVAX. So GLP can be viewed like an ETF. So although GLP is like $1 right now, it's broken down into smaller components like ETH, Bitcoin, Chainlink, Uniswap, USDC, USDT, DAI, and Frax. And each of these tokens have a different weightage as well. So in overall, GLP comprises of 48.6% in stable coins, which is pretty okay, and the remaining are in blue chips that we mentioned. So since we are providing liquidity, we are essentially providing money for traders who are doing leverage trading on GMX. And in return, we get a share of the fees. So as a holder of GLP, you'll earn rewards in either Ethereum or AVAX when a leveraged trader makes a loss, and we lose money when the trader wins money. So in simple words, we are kind of like the banker in the casino. We win when people lose money, and we lose when people win money. But before you jump into GLP, there's a stats page which can provide you information on the winning and the losing rates of traders on GMX. So this will give you some idea if investing the GLP is something you should do. So if you look at the trader's P&L, we can see that the losses are much higher than the gains, which means that if you do have GLP, you'll be earning some rewards, hence the high API right now. Lastly, we gotta talk about risk. So crypto being crypto, there's so much risk involved, be it in the DeFi or the CeFi or the CX space. And risk is something that you should put into consideration here. With CX, one of the biggest risks that I see is the regulatory risk. So being in Singapore, crypto is kind of in the gray zone right now. It's neither here nor there, but you see big institutional players holding them as well. And with regulatory risk, one thing that can happen in a CX is them being asked to pull out of a country, and when that happens, there might be a chance that we might not get our money back. And on the DeFi side of things, the risk here is a lot different, right? It's a different kind of risk. So since the DeFi space is unregulated, there are things like smart contract breaches, which we have seen, rug pulls, which I have been a victim of, and platforms getting hacked, or maybe even a user problem when your wallet is compromised and you lose all your tokens. So what's the strategy here right now? So right now I have roughly 25 to 30% of my net worth in crypto, which I plan on keeping it that way so I reduce the volatility risk since I'm getting a new house and all, and things gotta be a little bit more stable for me, hence I take less risk. So out of that percentage of net worth in crypto, 20% is being deployed into ETH staking and GRP, so this allows me to grow my crypto stash without injecting new funds. And at the same time, if the bull market comes back with tremendous growth, I can still enjoy some growth in the capital, which by then, profits will definitely be taken and then redeployed into other less risky investments for my retirement fund. So these are some of the current platforms that I'm using to grow my crypto stash. If you like this kind of content, do drop a like, do subscribe and stay notified. And as always, stay safe, invest safe, and I'll see you guys in the next one.